Today was an interesting day for markets. We did have the Basel Endgame proposal that got closer to being finalized. That sent a lot of stocks like JP Morgan down over 5%, which took a big hit to the banking sector today. We also seen oil that fell 4%, which is a pretty ominous heads up for what tomorrow's CPI report could look like. We also had the NFIB optimism index that came out today, and not as good as we thought. We also have some politics that are playing a role or impacting our markets today as we get the first debate between Trump and Kamala Harris tonight. It wouldn't surprise me if we do start to see some election uncertainties over the next couple of days. Mix that with a CPI report tomorrow, and volatility is here to stay. So we have a lot to get into in a very short amount of time. Hit that like button as well as subscribe to the channel if you have not done so already. And let's get into it. So first and foremost, I actually want to start with oil because oil is down 4.26% today. And oil is a pretty good barometer of economic activity, okay? If oil is strong, if oil is going up, that's a good sign for global economies. China is the biggest importer of oil. Some people say, hey, oil is being affected by China. It's also being affected by implied demand in the U.S. as well. So as China is weakening, implying less oil demand, the U.S. is also weakening, implying less oil demand. It's almost like the oil markets are telling us we're heading for a recession. Now, I think this is something to pay very close attention to over the next couple of weeks, because if oil continues to fall at this pace, then you really want to pay attention to this as far as a leading economic indicator. With that said, stocks today started off pretty strong and then kind of slipped towards the end of the day. I think part of this has to do with some of the political uncertainties that we're going to hear about tonight with the debate. And the other side of this has to do with the CPI report coming out tomorrow morning, in which yesterday we got China's CPI report that showed a fifth consecutive quarterly deflation report. And your year over year, month over month, 3-month inflation numbers also came in deflation, which is a really bad sign for the Chinese economy. The Chinese economy is basically collapsing as we speak. That's part of the problem for the US heading into tomorrow. We have had inflation reports lately that have come in really low. 2 of our inflation reports have come in 0.06%, 0.16%. I mean, these are pretty close to being in deflation. And I know this is going to sound crazy, but deflation is worse than inflation, because deflation means this hot sauce company is going to take in less revenue. This McDonald's black coffee, McDonald's is going to take in less revenue. When these companies take in less revenue, they start to fire people. And then those people that are fired cannot go out and buy the McDonald's coffee, which leads to McDonald's having even lower revenues, which leads to more firing, and it can be a pretty slippery slope when you start to get into deflation. And deflation is not something that you should welcome on a broad kind of level. I know it sounds great if your grocery bill goes down or your energy costs fall, but it's not a good thing. And that's some of the concern heading into tomorrow. What if that inflation report just comes in too low, almost deflationary? That's a sign the economy is weakening, that companies cannot pass on cost anymore, and to stimulate demand, they actually are lowering prices. I actually don't think a negative CPI number tomorrow would be good for markets. I know it sounds like it would be good for markets, but I don't think it actually would be. I think stocks would sell off pretty aggressively on that because of the implications that has for the US economy. Now, core CPI month over month is expected at 0.2%, the same as last month. So this number actually comes in on a decimal basis, so it's not actually a perfect rounded number like is suggested here on Trading Economics. Now, it's also rumored that the Fed has not decided on 25 basis points or 50 basis points for the first Fed cut, which is going to happen in 8 days from now. That the Fed is actually waiting on the CPI report that comes out tomorrow to give the final signal to markets. And if we do have a CPI report that comes in really low, the odds are good that we do get a 50 basis point cut. Now, what is rumored to happen at that point is the Fed is going to tell Nick Timiraos, Nikki Leaks, the Fed's mouthpiece over at the Wall Street Journal, what they want to do, and Nick Timiraos is going to set those expectations for markets. Because we are now in the Fed blackout period, and I think there's quite a few Fed officials that want to do 25 basis points and quite a few that want to do 50 basis points. And I think that's why tomorrow's CPI report is kind of the deciding factor of which way to go. And again, as I explained previously, if you get a deflationary report tomorrow or something that's pretty close to that, you're definitely going to get 50 basis points because the Fed does not want deflation. They do not want prices to fall, believe that or not, because that means, yeah, recession, it's coming. Now, if we get something that is more so in line with expectations, 0.2% give or take, that is something the Fed would welcome and probably only do 25 basis points. Renaissance Macro Research writes on X, my 2 cents, if the Fed goes 50 basis points next week, the dots won't matter. He's referring to the dot plot and the expected path of the federal funds rate via the Fed officials. If they only go 25, then the dots will matter. In the former scenario, Powell is in charge. In the latter, wasting time trying to forge a consensus. Currently, the odds sit at 32% for a 50 basis point cut and 68% for a 25 basis point cut. So I'm expecting these odds are going to move a lot coming tomorrow. And again, in a weird way, this sounds contrary to what a lot of people might think. I believe 25 basis points is seen as a good thing, as a positive for markets. The Fed being able to take their time and gradually get Fed policy back to a place of neutral, not being panicked to do so. If the Fed signals 50 basis points, then that's more of a rush to get back to neutral. That is only going to happen because the economy is weakening and the Fed is not confident only a 25 basis point cut will be sufficient to offset some of the weakening we're seeing in the economy. So I think whatever we get from Nikki Leaks tomorrow, if Nikki Leaks does suggest the Fed's going to do a 50 basis point cut or a 25 basis point cut, essentially the leak that we're going to get from the Fed, or at least we are highly expecting we will get, is really going to be important for the next week or so of trading heading into the Fed meeting on September 18th. Because again, the Fed's in a blackout period. So there's no Fed officials that we're going to hear from. The last thing that the Fed wants to do is surprise the markets with a 50 basis point cut when that's not the consensus view at this point. But it's perhaps what the Fed might want to do if that CPI report comes in really low tomorrow. Mohammed El Arian on X writes, both Brent and WTI are currently trading below $70 a barrel as demand concerns persist. This is economic concerns that are persisting. Ally Financial took a big hit today, as Zero Hedge says, craters after auto lender reveals delinquencies and charge-offs that are surging. Charlie Balilo on X says those calling for a 50 basis point rate cut next week should take a look back at January 2001 and September of 2007, when the Fed started cutting cycles with a 50 basis point move. If the Fed feels the need to go big because of a weakening economy, that is not bullish. In fact, every other time you have gotten only a 25 basis point cut to start, you have had a very bullish market. 2019, you were up, say 2 years later, 54.1%. In 1998, you started with a 25 basis point cut. Markets were up 40.4% 2 years later. In 1995, you started with a 25 basis point cut. Markets were up almost 73% 2 years later. In 2001, you started with a 50 basis point cut. Markets were down 31% 2 years later. And in 2007, you started with a 50 basis point cut, and markets were down 26.3% 2 years later. And actually, even 4 years later, after 2001 and 2007, you were still negative 5% and 12.6% respectively. So you basically had like a lost half decade if the Fed cut rates 50 basis points. So the bulls need to be careful what they're asking for. Goldman Sachs strategists say the US stock market is unlikely to fall into a bear market. They say because the economy is also partially supported by a healthy private sector. I don't know what they're really talking about here. Because if you look at the NFIB Small Business Optimism Index, that was down to 91.2 versus 93.6, which was the estimate, and 93.7 for last month. Hiring plans decreased while plans to raise compensation moved up. Net percent of firms expecting economy to improve fell to 13%. Only 4% said it was a good time to expand, down from 5% prior. So only 4% of companies' management thinks it's a good time to expand the business. I wouldn't say that's a great private sector. And I think this will be exacerbated by whatever we get tomorrow with CPI and the projected path of Fed policy. As Lance Roberts writes here on X, the path of equities post the first Fed rate cut entirely depends on whether the economy slips into recession or not. It's not even necessarily slipping into a recession. It's about the probabilities of a recession. We all remember 2022. That was a rough year, a bad year for a lot of sectors. And even since 2022, a lot of sectors have not recovered. Small caps, discretionary, consumables to a certain extent. They have not recovered. There's so many stocks you could point out here. Fubo, PayPal, SoFi, just to kind of name a couple, higher quality companies like PayPal and SoFi, right? These are companies that are growing, that are, doing well, generally speaking, and they still have not recovered. The Fed starts to spook the markets even more here and signals for a larger cut, then that's probably not going to be good for markets, generally speaking. That's probably not going to be great for some of those areas that have already not performed well in recent years. And again, it's all about the probabilities of a recession. Back in 2022, there was a 100% chance at one point of a recession. That was back in October of 2022. Markets were down about 27% and some change. We were pricing in a recession, clearly pricing in a recession at that time. Today, there's a 0% chance of a recession priced in by the markets. If that probability goes up to 10% or 20 or 30 or 40%, which should reasonably happen, that is a lot of downside that markets could see, right? That's a lot of downside that could happen for stocks. And that's the real risk, I think, for whether or not we go into a bear market or not, whether or not we see a larger decline, besides any, political uncertainties that we see, and which we'll talk about in just a moment. It is the fact that we need to price in more recession risk. We're not pricing in recession risk today. And as we price in that recession risk, stocks fall. Okay. So I think there's a lot of capitulation, if you will, with people that have called for a recession for so long. It has not materialized. We're heading into the first cut from the Fed. Historically, when you want to be defensive, like the best period during a Fed hiking or cutting cycle is after the first Fed hike, before the first Fed cut. So since July of 2023, we've really been in the sweet spot. And I think Wall Street has just gotten the economy wrong for so long. There's a lot of people trying to flip back and switch to the bull side when this could be precisely the wrong time to do so. Now, clearly, nothing is set in stone. We don't have to go into a recession. We could totally avoid a recession. That is certainly a possibility. But is it really the time to go bullish, super bullish, with election uncertainties, economic uncertainties, earnings estimates that are way too high, and the market's not pricing in a recession at all? Probably not. The NFIB Small Business Survey signals continued weak sales and profit recession. You can see these things tend to correlate pretty well. This here is the S&P 500 operating EPS in light blue. And then you have the 12-month trailing with consensus forecast for EPS. And you can see here, you're sitting at like 18% year-over-year expected EPS growth for 2025. Yet the NFIB is signaling that you could see 20 to 30% lower profitability in 2025. And this gap is widening. Typically, you tend to see these things follow each other pretty well, which creates the disparity here. Who's right? Who's wrong? Are small businesses seeing the weakness where the markets are not? Or are the markets seeing strength where small businesses are not? I think small businesses could be correct on this one, because theoretically they would be the ones that would be impacted by a weakening economy first. It is also being reported that U.S. online grocery prices plunged the most on record in August. This is according to Bloomberg, down almost 4% in just the last month, which I don't know if you can make the claim that grocery prices falling, seeing deflation in grocery prices means the economy is dramatically weakening. Like if you were to see that in services or to see that in other areas of the economy, it would be a much more definitive sign. But I'll tell you, it's probably not a good sign that you're seeing 4% month over month deflation in the grocery sector. UBS strategist sees a 10% downside potential. Houston, we have a near-term problem. Come in, Houston, bearish over the next 8 weeks, short IWM as a hedge, and market internal is vulnerable to any data shock. That is the new note out from UBS today. Liz Young-Thomas provides some interesting perspective here. On X, she says defensives have led since May 31st, with financials the only cyclical sector outperforming the S&P 500. Well, bad timing, because today financials are not doing well at all. Part of this has to do with a downgrade of JP Morgan from Deutsche Bank, an upgrade of Bank of America and Wells Fargo. Part of this has to do with some bad guidance revisions we're seeing out of Goldman Sachs today, and the Basel Endgame proposal comments from Fed Bar today. So there's a lot affecting your financial sector, and they're really underperforming today. But nonetheless, she says, interestingly, this also is what happened during the 1995 soft landing cutting cycle. Defensives and financials led while other cyclicals and tech lagged. Yardini says, quote, something doesn't make sense. Why are stock prices falling when the Fed is set to lower interest rates to avert a recession and stop the unemployment rate from rising by boosting economic growth? We had a glimpse of the answer in early August. The carry trade is still unwinding. Here today, the percent of stocks currently trading above their 50-day moving average is at 40.76%. You have 5% of stocks today that are breaking below their 50-day moving average. So today is actually not a great day at all for markets. You can see the S&P 500 is actually now in the green, up 0.04% today, but the RSP, the equal weight S&P, is down 0.34%. The 2 and 10-year yield curve inversion is uninverting and is now uninverted. Positive 5 basis points. This is the third day in a row that you're actually still positive on the yield curve inversion that is uninverted. Now, what's actually interesting about this is you tend to historically see pain in markets when you actually get the uninversion, when you actually go positive again. So now that we've been uninverted for 3 days, could this pain come? Yes. But normally you're about 3 to 6 months away from an actual recession when you get this un-inversion, which this does tend to correlate to the Fed, starting the process of cutting rates. Now, not every time the Fed has started cutting rates, like 1995, the yield curve never inverted, right? So only when the yield curve has inverted and then uninverted have you actually seen a recession. Not necessarily when you've actually seen soft landings like 1998, 1995. Yield curve never inverted during those periods. But now it did invert and was the longest inversion in history and is uninverting. So if we actually avoid a recession this time, this will be unprecedented, like has never happened before, where the yield curve, when inverted, uninverted, and theoretically we have a soft landing. That's just never happened before. Can it happen? Of course. But statistically, the odds are stacked against us. CNN's Fear and Greed Index is coming in at 38 today. Yesterday, it was at 42. So there's a little bit more fear today than yesterday. Market momentum is in fear. Stock price strength is greed. Stock price breadth is greed. Put and call options, extreme fear. Market volatility, neutral. Safe haven demand is fear. And junk bond demand in extreme fear. I am also expecting a little bit of political uncertainty to also come into our markets as well because of the debate that we have today. So it wouldn't surprise me if the markets start to pay attention to or price in some of economic policies from both aisles of the political spectrum after today. None of this sell-off that we have seen in markets has anything to do with election pricing in my personal opinion. But that is going to start playing a role in markets. There has been some calculations done by Goldman Sachs that has shown if the corporate tax rate is raised to 28% from 21%, where it currently is, that could cost the S&P 500 5% of its EPS growth for next year. So if we're expecting EPS on the S&P around 280 for next year, times this by 0.05, that could shave off $14 of EPS. Okay, that would be impactful. Okay, so let's say just to put math to this, that would be $266 of S&P 500 EPS. So times 280 by, let's say, what are we going to give the markets? 20 times multiple. Let's just say that. That puts a fair value on the S&P at 5,600, 560 on the SPY. If we give, the EPS of 266 EPS times 20 for the multiple, that puts a fair value on the SPY or S&P of 532. If you're looking at the SPY today, it's at 546. So there is a material difference here. Now, depending on what you assign the multiple to be, that changes things a little bit. If you say the multiple should be 21 because we're going to have a soft landing or whatnot, that still only puts a fair value on the S&P or the SPY at 558, which is about $11.50 of upside here on the SPY. That's still not impressive for the risk to reward, considering it's possible we could go into a recession. If you say EPS is still going to be 280, regardless of the problems with raising the corporate tax rate and how that would affect earnings. But let's just say things are super strong. And even though that 5% negative hit to EPS estimates, still has us at 280 for S&P earnings next year. Times that by 21, boom, now you have a fair value of 588 on the SPY. That's okay. I mean, that's what, $40, $42 of upside potential on the SPY. Like, that's decent. That's like 8% upside from here. But what the downside is still like 10, 20, 30%, depending on soft landing, hard landing, recession, no recession, recession fears, no recession fears. Like, there's not a really appealing risk to reward in markets right now. It's like very unattractive. Now, this is from the standpoint of raising the corporate tax rate. Now, it's a little more difficult to try to calculate what tariffs would mean for the S&P, and I haven't seen any exact calculations on that. If you guys have, provide that down below in the comment section. Would that be a 5%, 10% hit to S&P EPS for next year? I don't know. But I know it's not going to be good for economic activity in the short term either. So really, on both aisles of the political spectrum, there is negatives to be priced in here that have not been priced in yet for markets. And I think with the first debate tonight, you could start to see some of that pricing in here in the short term. I think most of the fear and the pricing in will actually happen in October, but I wouldn't be surprised if some of that does start tomorrow. So these are kind of my thoughts. Again, just to wrap up this video, I think you want to be defensive here. I think you want to have cash on the sidelines, but I do also think there are opportunities, there are deals out there to take advantage of them. If there truly is a soft landing and, things are great, I think you want to have exposure to certain areas of our markets. Cyclicals, consumer discretionary, right? Some of these areas, interest rate sensitive, could do well. And I think playing options could make sense to the upside, just risking the premium and keeping a lot of cash on the sidelines, like buying a call in the, a consumer discretionary ETF, right? Some consumer discretionary stocks. I think that could make sense. And keeping a lot of that cash on the sidelines to wait for a, buying opportunity, because if markets take off, you can exercise that call. You can just play the leverage on that call position. And I think it does give you more flexibility in this environment. I also think having a downside hedging strategy as well for markets makes sense from now until the election as well. I mean, last week we sold off 4% of the S&P. That was the worst sell-off we have seen since the banking crisis in early 2023, like 18 months ago, right? So I do think there is a lot of risk to the downside. But I also think there are ways to pretty cheaply play the upside so you don't completely miss out if things do go well. I think the odds are very much tilted towards more downside, but there's a chance we could always be wrong on that. Maybe the markets don't care about the election. Maybe there's no election risk that ever gets priced in. Maybe the economic data just comes in really good and soft landing becomes the standout probability for markets, and markets just run with that and take off. There's certainly that potential outcome as well. So let me know what you guys think about this information down below in the comment section, and let me know if there is some research that has been done on what the tariff policies, theoretical 10% tariff on everything coming into America, could do to S&P 500 EPS as well. Provide that down below in the comment section. I have not seen that research yet. I'm sure it's out there somewhere, but I have not been able to find it. And that would give us a little bit more clarity on maybe what some of the election uncertainties or pricing in of the election uncertainties could do for markets. So thank you guys for watching. Enjoy the rest of your day, and I will see you in the next one.